Hello everybody, today we will talk about price earning ratio. To begin with, a small disclaimer. We provide information for general guidance only. Please do complete research before you make any investment decision. Price earning ratio. It is a ratio of current price of share to earnings per share, and the formula is current market price of the share divided by earnings per share. Now, where will you find these values? The current market price can be found on the exchanges like NSE, BSE and all. And the earning per share, it can be found in the financial reports of the company. And it indicates what the investors are ready to pay for a share in relation to the company's earnings. It also helps investors understand if the company's shares are overvalued or undervalued. A higher price earning means the investor expects a higher earning. And when a company makes losses, or if it's a newly listed company, or if they have not previously reported earnings, then you will find that the PE ratio is expressed as not available. Now, while considering EPS, that is earning per share, you will find two types of EPS in the financial statements of the company. One is basic EPS and the other is diluted EPS. The basic EPS, we have covered it earlier in previous videos. You can have a look at it there. Here we'll cover the diluted EPS. Now, what does dilution mean in respect of shares? So, dilution means the reduction in the value of earning per share due to some kind of loss per share. Now, how does this loss happen? So, this loss happens due to the convertible instruments being converted or the warrants and the options being exercised. So, what are convertible instruments? The convertible instruments, they could be debt instruments or equity instruments. And debt instruments are like bonds, loan instruments, and all. And equity instruments, they could be like convertible preferred shares. So, these convertible instruments are converted into ordinary shares. They can be converted into ordinary shares. And options, they are traded in the financial markets by the traders. So generally the traders, they will speculate the price movement of a share. Like they'll say probably in 1 week's time or in 15 days time the price will move higher to a particular price point, or will move lower to a lower price point. So they will speculate, and by speculating they earn some money. Or hedging of the existing shares is also done, that is hedging the existing value of the shares. So that is the investors, they will take it at a particular price point, the share value, they will take it at a particular price point, and whatever be the movement, the higher movement or lower movement, but because they have done hedging, they will take it at a particular price point. And this is generally done in case of commodities. And all this is done to generate income from shares. Now, what are warrants? Warrants, they are issued by the company to raise capital for the company. So, when the convertible instruments, they are converted, or the options and warrants are exercised. By exercised, we mean they are sold in the financial markets. So, it might lead to some loss per share. And when it leads to some loss per share, it leads to reduction in the value of earning per share. This is called diluted earning per share. Apart from this, there is also something called forward price earning and trailing price earning. So investors might calculate the forward price earning or might calculate the trailing price earning. Now, forward price earning, they are values taken for the past 2 quarters, and the next 2 quarters values are estimated. So these are also called estimated price earnings. And basically you can compare the current price earning with the estimated price earning to understand the future movement of the price earning. A trailing price earning, it takes the past period, 12 months period, uh, and the current market price um, then is divided by the past 12 months earning per share. So you get the trailing price earning. So this is actually more popular than the forward price earning. Some of the investors, they consider both. What they do is they compare the forward price earning and the trailing price earning. So if the forward price earning is lower than the trailing price earning, then the investors expect that the price earning would increase. But if the forward price earning is higher than the trailing price earning, then the investors, they expect that the price earning would fall. To give you an example, let us take the example of Suzlon. If you look at the financial statement, that is the P&L statement of Suzlon, we find they have mentioned the diluted EPS for all the 4 quarters. So we have taken quarter ended 30th June 24, quarter ended 31st March 24, quarter ended 31st December 23, and quarter ended September 30, 23. When you add these diluted EPS, you get trailing 12 months EPS, TTM, which is 0.64. And the current share price as on 6 September was rupees 74.72 per share. So the price earning ratio is nothing but 74.72 divided by 0.64, which you will get 116.75. So if you look at the various investment apps or various investment company websites or all these investment magazine, um, you will find a value similar to this 116 what we have mentioned here. It might be slightly lower or higher depending upon what quarter they have taken or what current share price they have considered, but it will be somewhat similar. And what you can do is, once you find the trailing 12 months EPS, and once you find the price earning ratio in this way, you can find the price earning ratio of similar companies, that is other companies in the similar industry, and thereby you can compare the price earning ratio of all the companies along with Suzlon. So suppose Suzlon has a higher price earning ratio than the other companies, or if any other company has a higher price earning ratio, then the investor, they expect that the earnings would be higher, and therefore they might be ready to pay a higher price. Now we cannot just assume this by one ratio. We cannot conclude this. There are other ratios that need to be considered. Also, if you look at these investment apps and these investment magazines or investment company websites, they give you that you can buy the share, or you can hold the share, or you can sell the share based on all these ratios and all these financial metrics. So what we are trying to do is, when you look at these investment apps and these investment magazines or the investment company websites, and when you find such terms like earning per share or diluted earning per share or price earning ratio, you should know what they mean and how they are calculated. And so why have they given you a rating to buy the share or to sell the share or to hold the share? So you will be able to understand that in a much better way. That is why we are explaining. And you can also decide on your own. Even though they might have given buy, sell, or hold, you can decide what you want to do with the share based on the calculations you have done as you understand the concept better. So we are just trying to make you understand the concept better, so that it will be easy for you to deal in shares. So if you have liked the information we have given, and if you feel it was useful to you, please like, subscribe, and share. You can also give us your comments. Thank you.